Gold price is seeing another day of tumbling. Hi, I'm Joe Doe with The Street, here today with Kevin Quigg, Global Head of Strategy at State Street. Kevin, it's great to have you back in the studio.
It's wonderful to be here, Joe. Thank you.
So, Kevin, you follow gold and GLD, the ETF, very closely. People are wondering, what are we going to expect from the ETFs and from the gold price in 2014?
Well, I think the first point to make is you'll see the exact same thing from the ETF and the gold price because the Spider Gold shares is backed by physically allocated gold at the HSBC Vault in London. I really think gold, like anything else, derives its price from supply and demand. And I think oftentimes people like a binary explanation, but gold, unfortunately, isn't that simple. I think what we've seen more recently is the traditional strong seasonality of the gold market is not exhibiting itself this year. So traditionally, as we enter into the Indian festival season, followed by Christmas, followed by the Chinese New Year, followed by Valentine's Day, you see some seasonality in the jewelry marketplace.
We're just not seeing it.
On the Indian side, we haven't seen it so far. With that being said, that's not to say we won't see it, but again, from a supply and demand perspective, you'll see the same 5 factors that always affect gold's price. Number one, the balance of supply and demand. So we talked a little bit about the demand side from jewelry. You're also seeing central banks being net buyers, continue to be net buyers. Right. And you're also seeing some increase in manufacturing. On the supply side, you're seeing sort of benign or to very little increase in manufacturing production, but at the same time, with the price drawing back, you're seeing a decrease in the recycling. So the supply side might be a bit challenged in the coming year.
Sure.
The second factor you need to look to is inflation. What are you thinking about from an inflationary scenario? And that's not just U.S. inflation, that's global inflation, and more importantly, the perception of it. Number 3 is your view on currency. Again, particularly the dollar. As the dollar comes challenges, that tends to present an environment in which gold does well.
Sure, sure. And despite all of these facts, we still see, I mean, we're down more than 25% this year in the gold price. 2014, most of the major banks have price points that are much lower. Essentially, it's not looking good for the asset class. And so I'm wondering, despite the number of reasons that we can argue for gold, right? Inflation, sure, it still might be on the table. It hasn't popped up, a number of other things. I mean, really, though, what do we have to say out there to convince people that, yes, putting a little bit of your money in gold is worth doing next year as opposed to putting it in stocks, which appear to just not want to stop going higher?
Sure. Well, 2 things I'd say is, number one, on an ongoing basis, and this is statistically proven, that a 4 to 10% allocation of gold or Spider Gold shares will increase performance in a portfolio and decrease volatility. Looking at it in the marketplace, I'd probably look back. We're at the 5-year anniversary of the global financial crisis, and what was the asset of last resort that did well in that period? It was gold. When other areas were struggling, I'd like to have a magic ball and say I knew everything that was going to happen in the market over the next year. I don't. Most investors don't. And if that's the scenario, you should have an ongoing allocation to gold.
And so final question, do you see, though, gold probably going further down in 2014 like many of the experts are saying?
Well, I think that there's, again, a lot of factors that people can't quite put their hands on. And again, the biggest factor is probably the uncertainty in the marketplace. We think there's been resolution to the debt ceiling. We think there's a lot of things that have become resolved. But unfortunately, uncertainty tends to rear its heads when you least expect it. And that, again, is an environment in which gold has traditionally done well. And put it another way, as you noted, this year the equity markets are up over 25%. Gold is down over 30% over its high, which seems like a relatively better buy right now.
All right. Well, Kevin Quigg, as always, thanks so much.
Thanks, Joe, for having me.
For The Street, I'm Joe Doe.